What should you invest in your Roth IRA or taxable brokerage account for your early retirement? Before I go any further, please keep in mind that this is not in any form of financial advice. I just want to share what I do with my taxable investment account for my early retirement. I have two taxable brokerage accounts, and one of them is with Schwab, which is all dividend investing. And the other one is my growth portfolio, which has individual stocks, index funds, and ETFs. Now, I'm not going to focus on individual stocks in this video. I want to compare ETFs and mutual funds to talk about which one makes more sense. And later on in this video, I'm going to compare VTI ETF and VTSAX index fund. And if you're brand new to my channel, my name is Sai and welcome. My channel is all about how to achieve financial independence and retire early. I'm 36 years old and I've been on my F.I.R.E journey for the last 6 years. And I went from $110,000 in consumer debt to managing over 7 figures in total assets. And ever since I paid off my stupid debt in 2016, I've been consistently saving over 65% of my gross income. And out of that 65% savings rate, about 60% goes into my and my wife's retirement accounts. And about 25% is going into our taxable brokerage accounts. And how I prioritize my investment is really important because it's based on the time I have until I reach my early retirement age. And just real quick, before I go into the comparisons between ETFs and mutual funds, here's how we plan to prioritize our investments starting in 2023. My Roth TSP, which is the government sector equivalent to the 401k, is going to have $22,500 for my personal contribution and an additional $6,500 from the employer match going into the traditional portion of my TSP. That's a total of $29,000 in 2023 or $1,115 every 2 weeks between personal and employer contributions. My wife's going to have the same at $22,500 with her employer. For our Roth IRAs, we're going to each backdoor $6,500 or a total of $13,000 in 2023. And for our HSA, we're going to contribute a total of $7,750 for the family plan. And so that's a total of $72,250 just going into our long-term retirement accounts. We're always gonna prioritize our long-term retirement accounts because we want to use the time we have to build massive portfolios going from our 30s, 40s, and 50s. And 25% of that 65% savings rate is going into our early retirement in our taxable brokerage accounts, investing in securities like individual stocks, ETFs, and mutual funds. And I also encourage you to download my absolutely free financial independence checklist by visiting firesightchat.com/contact. I also have other financial resources like spreadsheets to calculate your compound interest. And I'm following my FIRE checklist, and I don't plan to deviate from the checklist unless something significant or life-changing event happens in my life. So anyway, let's get into the ETFs and mutual funds. ETFs are by far more tax efficient because they have fewer taxable events than mutual funds. And when we contribute to our taxable brokerage accounts, we want to minimize taxable events as much as possible because they don't have the same benefits that we enjoy with our 401k, Roth IRA, or HSA, right? Whether you own an ETF or an index fund, both are subject to capital gains tax and taxation of dividend income. So at the end of every year, you need to look out for the 1099-B, which is used to report sales of stocks, bonds, and mutual fund transactions, and the 1099-DIV or DIV, which is used to report dividends and other distributions. An investment manager for a mutual fund is in charge of rebalancing the mutual fund by selling stocks or securities inside the fund to reallocate assets. And the target retirement fund is a prime example of constant portfolio reallocation. So anytime the mutual fund manager sells a stock, it could lead to capital gains or taxable events. Even if your mutual fund is down, let's say 5, 10, or 15% for the year, like we saw in 2022, this is more common with actively managed mutual funds that constantly try to beat the overall market. A passively managed index fund is much more tax efficient than an actively managed mutual fund because of lower turnover or lower sales inside a mutual fund. And I hope that makes sense to you so far. And if it doesn't make sense to you and you need help with your personal finances like budget, savings, and investments to achieve your financial independence, You can schedule a free one-on-one 20-minute financial coaching session by visiting firestarchat.com/coaching. An ETF, on the other hand, is traded on the stock exchange like an individual stock. The market price goes up or down based on how many buyers and sellers there are involved in the ETF transactions. The ETF manager does the inflows and outflows of thousands of stocks, kind of similar to mutual funds, but they don't distribute many capital gains like the actively managed mutual funds. ETF managers can also create or redeem ETF shares, and that leads to reducing capital gains. But just like mutual funds, some ETFs pay dividends and you will owe taxes on them if they're distributed in the taxable brokerage account. And what I also like about ETFs is transparency, and most of them disclose their holdings on a daily basis. The net asset value, or NAV is what I call it, of an ETF is basically the sum of all assets, including cash minus the liabilities, and then divided that amount by the number of shares outstanding in the ETF. I know that might be confusing to some people, but let me just simplify it for you. It's different from the market price when you research any ETF because NAV is the value of each ETF holding based on the shares portion of the fund's assets at the end of the trading day. And it's calculated just once at the end of the trading day after 1 p.m. Pacific time or 4 p.m. Eastern Standard Time. It's basically to tell me as an investor of the ETF's daily portfolio holdings as a part of its transparency. And I also feel like it's easier to navigate different types of ETFs. And in the past, I've owned sector ETFs like healthcare, high dividend yield, and technology. The tech sector ETF, that was my favorite one, back in 2019 gave me over 40% in return, which was absolutely incredible. And again, because ETFs have lower turnover ratio and use the in-kind creation and redemption process, they generate far fewer capital gains for us investors than the actively managed mutual funds, which makes ETFs much more tax efficient. And I'm personally a fan of both ETFs and index funds. And I never invest in any actively managed mutual funds because of the turnover ratio and high management fees. So let's compare VTSAX, VTSAX, and VTI, and I want to talk about which funds I choose to invest in. So both funds give you the same level of diversity, but they function the same. They're both index funds and passively invested with very low expense ratios. VTI acts like a stock, so you can trade it when the stock market's open. VTSAX is a mutual fund, so the transaction doesn't take place until the market closes. They both invest in 4,076 stocks in small, medium, and large cap stocks. VTSAX's expense ratio is 0.04% and VTI is 0.03%. So what that means is that I'm going to pay $3 or $4 for every $10,000 I own VTI or VTSAX. The minimum investment price is $200 as of right now for VTI and $3,000 for VTSAX. If you're just starting to invest, VTI might be the best way to start with $200. And for VTI, if you have $500, you can only buy 2 shares of VTI for $400 with almost $100 left in cash. So you're not fully invested because you can't buy fractional shares unless you're in a certain brokerage that allows you to purchase fractional shares. But with VTSAX, I can make automatic investments every week, every 2 weeks, or every month. And it also allows me to purchase fractional shares after I make the minimum investment amount of $3,000. So after $3,000, I could invest as little as $1 in every transaction. So for $500 with the NAV price at $98, I could purchase 5.102 shares of VTSAX. But does it make sense to own both VTI and VTSAX? No, it doesn't. They're both basically the same funds that function differently. And I own either VTSAX or VTI in one brokerage account. For example, I have VTSAX in my Roth IRA because I get to invest my money into VTSAX automatically every 2 weeks, and I never have to worry about it. My Roth IRA is a long-term retirement plan, right? I have VTI in my taxable brokerage account because I like to buy a limit order of VTI and set the price I want to purchase. So if I set my limit order to $200 for 3 shares, then the transaction doesn't happen until the share price drops to $200. What I also did was I initially invested in VTI in my Roth IRA, and then I eventually sold VTI shares when it reached $3,000, and then bought VTSAX with the same money to create automatic investments. You don't have to do this. It was just something I decided to do to simplify my investments. And before you buy any ETFs, mutual funds, or individual stocks, you need to be able to research them at a high level. When you start buying ETFs, index funds, or stocks without knowing what they are, you're essentially gambling. And if you don't understand what an expense ratio is or how to measure its volatility, you're just throwing money at the roulette table hoping to hit black or red, right? Now, when it comes to index funds or passively managed ETFs, they're really simple or easy to understand because they follow the overall market index. The S&P 500 ETF tracks the performances of the S&P 500, but you still have to understand the risks associated with these ETFs or index funds. How is investing in an ETF or index fund going to help you achieve financial independence? What is your ultimate FIRE number, or just a FIRE number inside these taxable brokerage accounts before you decide to pull the trigger to quit the 9-to-5 job? And if you want to know more about how to invest for your financial independence and early retirement, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.